For more on the Canadian economic picture, we are joined in studio by Royce Mendes. He is Managing Director and Head of Macro Strategy at Desjardins. It is nice to see you, Royce.
Nice to see you as well.
And it is increasingly feeling like all eyes are on the consumer. What's your take on what's going on right now?
Well, it's really incredible to hear from retailers how challenging it is out there, because we've seen population growth spike to levels that we haven't seen in decades. And that should be growing the pie for these retailers. That really tells you how much each individual consumer is pulling back. We know that retail sales per capita are very weak in this country, and that's because higher interest rates in Canada do a lot more to slow down spending by Canadians than they do in other parts of the world. I'm thinking specifically about the U.S., where the consumer is driving economic growth instead of dragging it like it is here.
How much does that have to do with our mortgage market, where people are cycling into a new mortgage product on average faster than the U.S.?
It has to do with two things. One is that we just hold a lot more debt. On average, the debt to disposable income ratio in Canada is 180%. It's roughly half that in the U.S. And then you talk about the mortgage market. We are on that 5-year cycle here. So roughly 50% of the mortgages have renewed in this higher interest rate environment, but there's another half that have to. And those will be the ones that will feel the most pain. When we look out to 2025, those are the ones that will be renewing from the very low interest rates of 2020 and 2021. So they'll see the largest payment shocks, but also we have more variable rate mortgages in Canada than the U.S. does. So a lot of people are going to be feeling the pain. Actually, when it comes to renewal, these variable rate products, most of them have fixed payments. And so the payments haven't changed. In fact, probably over 90% of people with those products owe more interest every month than they're actually paying in the payment. And so their mortgages has actually been growing. All of these things really come to a head actually in the future. So it's incredible, again, right now that we're already seeing consumer spending slow down so much that retailers are feeling it.
And I guess another part of the equation is how many people are employed. It's tough if you have less disposable income, but it's even tougher if you don't have a job. We do have a jobs report tomorrow. What are your expectations?
Look, it's always tough to make a forecast on the labor force survey because of the severe flaws in the way it's designed and published. But we expect that the unemployment rate is going to remain above 6%. And I think that's really key. That's key because it means that the labor market is not as tight as it was in 2022, obviously, when there was extreme labor shortages, but it's not particularly weak. It's not signaling that we're in a recession. So generally, most people in Canada still have a job. They're still fairly confident in their employment prospects, and they should be feeling like they can spend. But for, as we talked about, it's these higher interest rates that are keeping them concerned and keeping them on the sidelines from spending. On the flip side, we're also hearing about renters. So people who don't have mortgages that are also pulling back. We're seeing increased delinquencies in lines of credit, in auto loans, in credit cards, and renters are actually feeling the squeeze too, even though that they're not exposed to the mortgage market.
So if you're the Bank of Canada and you can see all that data, and inflation has been problematic and sticky, and you don't want to shift policy on rates if you're concerned about inflation continuing to be a problem, but if there are signs of cooling spending, what do you do?
My view is that the Bank of Canada's metrics for measuring inflation are actually lagged and somewhat flawed. Though we've made some adjustments to their metrics to make them more appropriate to capturing really quickly the changes that we're seeing in the underlying economy and price movements, and we've seen a lot more normalization. And you look across, we cut and slice this inflation data. All of the things that we're looking at suggest that we are getting a lot closer to that 2% target and sustainably being there. So from the Bank of Canada's perspective, I think they have to take a much more balanced approach to the economy and interest rates. Over the past couple of years, it's been all about getting inflation down. Now we need to do things to protect the economy. That doesn't mean slashing interest rates, but it could mean beginning a rate cutting cycle that could be a gradual one as early as next month.
And you're someone who has been pretty consistent in making that call. And for those who are just trying to get a sense of a roadmap, what is your current thinking? And I know that changes with every new data point.
I think that they could cut rates a handful of times. So let's say 4 times this year, and they could continue cutting rates all the way down to about 2.5% over the next few years. I think they're going to need to do that to offset the drag on the Canadian economy from these mortgage renewals, because, as I said, the wall of mortgage renewals really only starts in 2025. And there's no silver bullet. It's great that incomes have increased. That'll help people deal with their payment shocks on their mortgages. But there's really no silver bullet. The closest thing we have to it is to get interest rates down. And to do so, we need to start early and do it, pretty soon to get them down before that mortgage renewal wall really hits.
Just a final question, comparing Canada to the U.S. I mentioned we've got some new data today. Over the last week, there's been the idea of interest rate cuts coming maybe at some point this year in the U.S. back on the table. We were off the table, we're on the table, blah, blah, blah. But there does seem to be a fairly consistent dialogue around the idea that there is going to be a disconnect between Canadian rates and U.S. Or there already is, actually. And then that opens the door to, well, how out of alignment with the Fed does the Bank of Canada want to be? Does that influence our Canadian dollar? Do we import U.S. inflation if our dollar weakens? How do you think about Canada as it pertains to our literally our neighbor and what they're doing?
It's really interesting. You get a lot of diverse perspectives on this. On the one hand, you hear people saying that really the Bank of Canada can't move too far away from the Fed because it's going to push the exchange rate up, and that's going to import inflation. On the other hand, we've heard a chorus of economists coming out and saying, the Bank of Canada's own models say that you can actually diverge pretty far. As always, I think the truth lies somewhere in between and is more nuanced than either of those narratives suggest. What we think is, yes, the Bank of Canada can move, and the exchange rate on its own that would be driven from interest rate differentials won't be enough to drive imported inflation. But there's always other shocks that happen in the real economy rather than, the Bank of Canada's laboratory that they use with their models. And you could see other things, a risk-off sentiment in markets pushing the Canadian dollar weaker. That could be a problem. The other limiting factor is that when you get exchange rate depreciation, it eases financial conditions. It's actually almost like a substitute for a rate cut. So we actually think that the Fed is going to be starting to cut rates around the end of the year. That probably means that the Bank of Canada, will generate some exchange rate weakness in the near term and doesn't have to do as many cuts as it would have if the Fed has started at the same time. So as I said, the truth is somewhere in between those two polarized narratives about exchange rate, interest rate differentials between the two countries.
Okay.